what is transfer pricing?
Transfer pricing is simply when you sell goods and services to your related parties, anybody that has any relationship with you, including legal entities and natural persons, you must price it appropriately as if you were dealing with people that you have no relationship with, so that the taxes you pay are not unduly manipulated.
That teaser is our own way of welcoming you to today's episode of Tax Matters, on which we'll be looking at one topic: transfer pricing. Transfer pricing alone. Christina Pius is here with me to bring us her report on what transpired at a workshop put together by the Federal Inland Revenue Service on Friday, June 21, 2013 in Lagos.
Hello and welcome to Tax Matters. Yes, indeed. On Friday, 21st June 2013, the Federal Inland Revenue Service hosted stakeholders to a workshop on transfer pricing in Ikeja, Lagos. The objective was to further rub minds on the Income Tax Transfer Pricing Regulations number 1 of 2012. The acting executive chairman of the FRS, Alhaji Kabiru Mashi, was represented at the event by the coordinating director, Field Operations Group, Mr. SS Ogunbeson.
What are we doing here today? It's just to talk to ourselves about the progress we've made with respect to transfer pricing rules and regulations, and to let you know that we are ready on our part to begin to work with the business community. That's all we're here for. It is not a forum to begin to start all over again what we have done since 2011. We've achieved some milestones, and we now want to begin to capitalize on those achievements and make sure we're able to sail them through.
2 papers were presented at the event, one by Mr. A.J. Bamidele, Director, Land Tax Office, Oil and Gas at the FRS, and the other by Mr. Taiwo Oyedele, Partner and Head of Tax at PricewaterhouseCoopers.
So what is transfer pricing? Imagine for a moment that you bought a plot of land for 10 million naira in Lekki Phase 1 10 years ago. That land is currently worth 50 million naira. If you sell it, how much gain would you have made? 40 million. God bless you abundantly. If you sell that land, your gain will be 40 million. Governments will show up and say, thank God for this, your land. Based on the available records we have, when you bought it, you paid only 10 million. Thank God you have sold now for more than 10. Actually, you sold for 50. Out of your 40 million naira gain, please pay what percentage? 10%. Government shall collect 4 million naira from you, even though government did not contribute when you are buying. But that's what the law says. Again, imagine another scenario. That same land, worth 50 million, you decided that you're not going to sell it for the market price because you're selling to a friend, to your spouse, to your sister, to your brother, your uncle, or your parents, whoever. And you said, because you are my brother, buy this land for only 20 million. And you agreed. You may even have documentation, including agreements. Both of you signed. Everybody signed. It was stamped at the stamp duty office. Your gain has reduced to how much? 10 million. And your capital gain tax should be how much now? 1 million. It was supposed to be 4 million before. Suddenly, it's now 1 million. And government is asking, why should I suffer? Because of your decision to sell this land to your brother, and you refuse to sell it at the market price. You know what? I do not care what you have done. I do not care what agreement you have in place. For the purposes of taxation, I would assume still that you have sold for 50 million. So please bring my 4 million naira capital gains tax. That is transfer pricing. Okay? It's not totally new to us. It has been there before. Only that we do not have detailed guidelines about how to implement it. Okay? But generally speaking, transfer pricing is that price at which related parties, or if you like, call them connected persons, transfer goods, services, intellectual properties, intangible assets, guarantees, loans, and so on and so forth between them. Sometimes the driving factor is to shift your profits from a country where the tax rate is very high to a country where the tax rate is very low if you operate in more than one country as a multinational. There's every incentive for you to play around with prices and costs such that profit is reported in the country where the tax rate is very low, and in some cases where there are no taxes at all, and that's what we call tax havens. Should government fold their arms and allow you to do whatever you like? Answer is no. Otherwise, we will soon get to a point where you have all the companies in Nigeria and collection for tax purposes will be zero. In fact, it can even be negative because not only are they not paying taxes, they are collecting incentives and they have tax credits, filing for refunds. There are some concepts in transfer pricing that you need to be aware of. And Mr. Bamidele was talking about documentation, which is very important. But do not make a mistake. The fact that you have an agreement in place does not mean you have documentation that is acceptable for transfer pricing purposes. Beyond the agreement, there has to be a justification. You're paying management fees. You're paying technical fees. You're paying a royalty, 10%, 5%, 6%, 8%. Who says it should be 8%? Why not 2%? Why not 15%? What is your basis for concluding what the amount should be? That is one key question transfer pricing would ask you. Now, in trying to determine what is the right amount of reward or compensation that anybody should earn for their activities, you consider three factors. Number one, we call it functional analysis, i.e., what functions are you performing? Number two, assets deployed, i.e., you may, on top of performing some functions, have to use certain assets. Those assets may be owned by you or owned by the customer. Now, the third thing is risk assumed. In financial management, we say the higher the risk, the higher the expected returns. This principle applies always, everywhere, at all times, around the world. When you are talking about transfer pricing, three key considerations, do not forget: functions performed, assets deployed, and risk assumed. All things being equal, in a perfect world, we expect there should be a correlation between the amount of those three items and the level of remuneration that you earn. Transfer pricing method is what you have in the regulation, and we also have this in the OECD guidelines, as well as the UN model, whereby we can think about what method is most appropriate under the circumstance to deal with your transfer pricing analysis. And then you have benchmarking studies. Now, this is also to help you with comparability. There are some guys around the world, they spent a lot of money creating databases. So if somebody borrows a loan in Nigeria from a related party, and the loan is denominated in dollars, and the interest rate is 7%, you cannot be comparing a dollar loan at 7% with if they had gone to Zenith Bank to borrow naira, isn't it? Because the person that borrows dollars is exposed to an additional risk that the person that borrowed naira is not exposed to. If you borrow 1 million naira, it will always be 1 million naira. So when you are paying back. But if you borrow $1,000, you could bring it in at 150, is 150,000 naira. By the time you are paying back, God forbid bad thing, it may be 200 naira to the dollar. To find the $1,000 you borrowed, you need far more naira than you got at the time you borrowed. Therefore, I expect the interest rates on a dollar loan to be lower, so that there's a margin for you to cover your extra risk of exchange difference. Okay? So, but who says 7% is the right percentage? You can then query the database and ask the database to give you information under similar circumstances for people who borrowed during that period that are totally unconnected. That is what we call benchmarking analysis. You're comparing your own scenario with scenarios of other similar transactions around the world. If you can find Nigeria specific, fantastic. Otherwise, find from other countries and make adjustment for what we call country risk. I told you about methods before. There are two categories of methods, essentially. There are those we call traditional methods, and there's those we call transactional profit methods. The traditional method, essentially, they focus on what price other people would have paid dealing with unrelated parties. Whereas the transactional profit method is looking at the entities involved and say, let's adjust their profit. Let me give you a real-life example. You know that Boeing and Airbus are the two leading aircraft manufacturers in the world. Boeing is American. Airbus is Europe, okay? So they are European organization, so to say. Boeing was ahead of Airbus in creating an aircraft that was lighter than what everybody had before. The lighter the aircraft, the lower the fuel consumption. The lower the fuel consumption, the more profit the airline can make. So it makes sense. Suddenly, Boeing had a lot of orders in billions of dollars. Airbus couldn't fold their arms and just watch them do that. Just last week, there was something on BBC and they said, even they have now discovered how to do it, that they are going to make their own plane. It will be lighter than the one of Boeing, and that it will consume 25% less fuel. And they said on the average, one aircraft that they use in Europe for commercial airline consumes 10 million liters every year. 10 million liters. So if you reduce the consumption by 25%, you save 2.5 million liters. That's a lot of money. But guess what? The aircraft that they are going to produce, that they are proud, they have not even produced it, that they are proud of, is not going to be produced in one country. They said the UK is the one that will do the wings, and then they will do the landing gear. The other parts, the engine, the rest of the engine, the cabin fittings, the frame, are going to be done in other countries, including France and Germany. When they are done, you know when they are selling the aircraft, it's just one product they are selling. Who determines how much profit should go to the UK, should go to France, and should go to Germany? It's very complicated. So in that example, you cannot be talking about how much would they sell to third parties. Nobody sells wing. Have you bought wing of aircraft before? They don't sell it. So all these traditional methods will not even work. So what you then do is all of you come together. This plane that you just sold, how much is your profit? They say it's $10 million. Say, that's good. You, in the UK, what did you do inside this particular exercise? He will tell you. You in France, what was your own? You in Germany, what was your own? What risk did you assume? What asset did you deploy? Once you have that information, you now share the 10 million between the three of them. So that's why we call it the profit split method.
It's getting interesting, isn't it?
Yes, it is.
We'll go for a short break. When we come back, Mr. Oyedele will still be here. The topic, don't forget, is transfer pricing. Don't go away.
How long it will take for you to clear my container?
I dey do am, Oga. Then Sable will go bring our team.
Our team? Which team?
Custom don't change, Oga. And FRS Sable.
I want to concern FRS with my business. I will talk to Gaba myself. You are fired. Oga Gaba, which one be this our team again?
The taxpayer identification number now the only way where you fit take do business with Nigerian Customs Service now. You fit process your own free tin, sharp for any FRS office.
Soji.
You don't sack me, no.
Get our tin. Now.
This message now from Federal Inland Revenue Service and Nigeria Customs Service.
Okay. Now, documentation is key. There's no doubt about that. If you can't do documentation, forget about TP. You are exposed already from the very start. The OECD had done a lot of work in the world of transfer pricing, including how to do documentation, and they have what we call a 9-step approach.
Mr. Oyedele went on to share some case studies with the audience.
This is to do with Kenya, where Unilever manufactures goods in Kenya, and they were selling to Unilever in Uganda at a price lower than they were selling in Kenya. KRA came out, Kenya Revenue Authority, and said, no way, your prices are too low. They had just said they asked them to pay tax. They refused. They went to court. The court said their strategy is to gain the market in Uganda. You cannot compare the price in Kenya with the price in Uganda. and that Unilever had followed OECD methodology in coming to that price. Therefore, it was accepted, and they went ahead and they win the case. Okay, so that's to tell you documentation is very important. Otherwise, your case will be very weak. This is the highest one single transfer pricing adjustment in the history of the world. GSK in the UK spent money on research and development to develop a trademark, but the market for the product is actually in the US. So the question was, for every $1 of profit, what percentage should they give to the UK for their trademark? What percentage should go to the US for the marketing and sales? GSK allocated 70% to the UK and 30% to the US. US authorities came out and said they must be joking, that they should have given them 80% instead of 30% and give the UK only 20%. Of course, they went back and forth and finally agreed that it should be 40% to the UK, 60% to the US. Guess how much that was? It was $3.4 billion additional tax that they had to pay. Luckily, because of the treaty between the US and the UK, they got some corresponding adjustments. Why now? Why are we introducing transfer pricing? Shouldn't we just allow us to worry about the problems we have? No, we cannot do that. Okay, the reason why this is happening around the world is the fact that people need to protect their tax base. You need money for infrastructure, for public security, for healthcare, for education. There's a lot of pressure. And fiscal authorities around the world are now exchanging information more than ever before. And I'd like to just share this with you very briefly. The Economists, some of us read the magazine, they said that Africa is a hopeless continent. The whole world were meant to give up on us, that there's no way we can be rescued anymore. That was a few years back. Today, that same economist says that Africa is rising from a hopeless continent to Africa rising. What has changed is because the world is looking for growth and they can't find anywhere else. And the growth is in Africa because we were almost starting from zero base. The whole world is paying attention to Africa. And when they talk about Africa, the first place that comes to mind is our dear country, Nigeria. We are 170 million people out of about 1 billion. It's like 1 in every 4 person from Africa is Nigeria. We are the China of Africa. We are very important, in case you are not aware. So therefore, because people will be coming to invest, they will say there's no electricity, that there's Boko Haram, they will still come. You know why they still come? It's because there's a level of risk and there's a level of reward. No matter how high the risk is, if the reward is commensurate or a little bit more, people will take the risk. I'm not saying and I'm not suggesting that we shouldn't deal with our issues. It means that if you deal with those issues and your risk goes down, more investment that would have been otherwise not viable automatically become viable. Instead of expecting 10% return, 4% will do. So you have more employment and you have economic growth. So Nigeria has to put in place structure so that as people begin to come in, more of them will be coming. We must ensure that they pay the right amount of tax based on the economic activities they carry out within our jurisdiction.
The conclusion, the advice, Mr. Oyedele's advice.
First is, even though the law says, the regulation says, you must do transfer pricing analysis and documentation for your accounting period commencing after 2nd of August, which means if your year-end date is December, it affects you only from 1st of January 2013 to 31st December 2013. The returns are due 30th June 2014. You say, why are they now disturbing us? We're still in June 2013. Why can't we rest? You cannot rest. You know why you cannot rest? As you are recording those transactions, you must ensure you are recording the amount that's acceptable. You've recorded transaction already for 6 months. If you now get to June next year and you start adjusting it, you create unnecessary complication. So the time to act was yesterday. Since you didn't do anything, the next best time is today. Do not wait a minute longer. Global policies. If you work for a multinational and they say to you, we have policies already, just come and collect and copy and paste. You say, yes, we can copy and paste, but you must pay special. You know why? Because this environment, we have our own peculiarities. So don't just copy and paste. What do? You paste special. Other issues are potential conflict between what the transfer pricing regulation says and what other regulators are saying. The one that worries me the most is NOTAP, because NOTAP is claiming that they know what they are doing and that they think their issue too is transfer pricing, even though they were not set up to do transfer pricing. In the regulations where the regulator or any other government agency has set the price, the taxman can accept it. That's what they call safe harbor. So which means don't go and bother yourself. If you sell petrol to your subsidiary at regulated price, what transfer pricing are you doing? Government set the price and we are using it, okay? But not in all cases. So if NOTAP gives you an approval, don't go and relax and say that's done, because the taxman may not accept it. What are the next steps? What should we be doing? Transfer pricing is here. We don't need to debate it. We must grow into it and be able to run with it. So which means everyone that is going to be affected, you'll be affected if you have any related party at all, whether they are domestic or they are foreign. It doesn't matter where they are. So long as you have a related party, be you incorporated or unincorporated, you need to deal with transfer pricing. You need to review and update if you have any policies in place. This will be suitable for multinationals. So if they send you something from your headquarters in Europe or America, collect it first. It is only the starting point. It is not the finish line. So you need to work on it and modify it for suitability. If you are in doubt, don't go back after today's session and say, I'm now an expert in transfer pricing. That's not how people become experts in transfer pricing. This is just the starting point to create the awareness. Try and know as much as you need to know about it. But if you don't think you feel 100% comfortable, talk to experts to assist you. And while they are assisting you, you should learn in the process. Don't go and relax and say, now some guys are doing it for me. Do it jointly with them. It's also about your business. If you ask me, I think that taxation is now the most interesting profession in the world. And it's also the case now in Nigeria. In those days, when some of us started, and it was not very long ago, it used to be that you do calculations alone, go to FRS, do TCC. Now it's becoming very interesting with stuff like transfer pricing.
Did you hear that?
Yes, I did.
Taxation is now the most interesting profession in the world. I agree. In toto.
Mr. Ajayi Bamidele, Director, Land Tax Office, Oil and Gas at the FRS, presented a paper on transfer pricing regulations. He went through the clauses of the regulations one after the other. But more importantly, he defined related parties and connected parties under the transfer pricing regulations.
There are so many interpretations, so many definitions that are being given to transfer pricing. But in simple form, it's just we are looking at connected parties. And there's nothing wrong with transfer pricing. Maybe I should echo that. In transfer pricing, nothing is wrong. What is wrong is transfer means pricing. And when you disclose your relationship, we just test that, okay, if this business has been done with a third party, will it actually have put the result in what you have declared to the government? This regulation was signed in August and gazetted September 2012. The question has always been, who is my related party? Or who is my connected party? How do I know that I'm connected or related to a particular person? And in that regulation, we have a particular regulation that talks about it. It says in this regulation, a connected taxable person includes persons, which means husband and wife, or any son or grandson or grandchildren, individuals, friends, entities, companies, partnership, joint venture, trust, or association, and collectively known as connected taxable person. And it's not limited to that. We also incorporated in area section 13(2)(d) of Company Income Tax Act, section 15(2) of Petroleum Profit Tax Act, where it defined connected persons, and then section 17(d)(b) of Personal Income Tax Act, then the OECD Article 9, and the associated enterprise as defined in OECD. And by the time you look at all these definitions, you can clearly understand what connected taxable person actually mean.
On that very day of the workshop, we sat down with Mr. Bamidele and his deputy at the Federal Revenue Service, Mr. M.O. Bojubola, to seek further clarification on certain aspects of transfer pricing. That interview and the interactive session that followed the paper presentations will form the main menu on next episode of Tax Matters. From Christina.
Thank you for watching and bye for now.
And from me, stay blessed.